Um, we are at 708 Lady Street. A little bit of information about me in case any of you guys want to know more about myself. This month marks 20 years of being in the business, and I've worked anything from a small mortgage company like Resource Financial is now to the big corporate giants like Merrill Lynch, and even smaller community banks as well. So kind of looked and been in all different facets of the industry. Here's my contact information here and cell phone too. A couple little highlights on our rooftop patio. We do a happy hour every third Thursday. So if there's questions that we don't get answered here, come see us tomorrow, have a drink on us, get more questions answered. Melissa will probably be there too, so you can badger the underwriter for any other questions and so forth. But every third Thursday of the month, we have a happy hour. Great networking for you guys. We know this is all about relationship, business, and so forth. So thank you for allowing us to participate, and thank you to you guys for joining, learning more about the industry that you're in, and the partners that you have is kind of instrumental into your success. So thank you again, and we will kind of jump into it. So a lot of the questions that you guys sent in were very good questions. A lot of them had to do with, hey, what's up with Joe Biden? What's up with all these industry changes that he's been making, really over the past couple of months. And some of those big changes started taking place. Actually, the media portrayed it as they were taking place May 1st. And in reality, lenders started making those changes really back in February and in March, because when a lender delivers a loan to Fannie Mae, they have to have the file set up right. And for all those changes to take place, that has to be structured from the beginning of the lock period. So when the loan gets sold to Fannie Mae by May 1st, those changes have already been implemented. So if you had clients that were in the middle of buying a house that were worried about all these changes, chances are those changes were already in effect in their loan. Some of the big changes that took place last year had to do with second homes. So being in central, South Carolina, we deal with clients that may want a referral to an agent over at the beach, or a referral to an agent over in the mountains that's buying a second home, or they want to buy a second home over at the lake. So some of those loan level price adjustments that you heard, Lester Holt or Chris Cuomo talk about, or whoever, some of those loan level price adjustments were already in effect for second homes. And then some of the ones that took effect, I'll go over here in just a few. Let me screen share.
And just to add on with what Jennifer's talking about, there's always been like adjustments, loan level adjustments that Fannie or Freddie looked at as far as risk factors of the loan. So it's not a situation where all of a sudden they implemented this. They just made some adjustments based on new initiatives in the market now, for more people to own homes, and maybe people with lower credit scores and that kind of stuff.
Yeah, absolutely. So the previous loan level adjustments that were taking place, so whenever lenders are pricing out a mortgage loan, depending on the type of loan program, if they have a 620 versus a 720 versus an 820, there could be adjustments to the rate or how we price out loans. So just kind of throwing a wild hair out there, this is one of the charts. This is the previous loan level price adjustment chart. So I think the media has used the word tax lately. Like Melissa said, these taxes or adjustments have always been there. They've just been enhanced for some borrowers or changed. So say, for instance, we've got a client that is, buying a, $400,000 home, putting down 10%, and they've got, let's say, a 720 credit score. So what lenders would look at before, and I'm just kind of randomly making this up, so let's kind of see how it looks. So we've got here this 85% to 90%, so they're putting down 10, and they've got a 720 credit score. They're going to have to pay an extra half a point. This is the old chart, half a point, because of that loan scenario. So what's changed now that same 90% loan to value or 10% down at a 740 credit score, they now have to pay 0.75 for that rate. So a little bit of a difference there. One of the big changes was promoting home ownership affordability. And there's also been a change with the credit scores. So before, with the LLPAs, you can see with this chart, hopefully everybody can see it. 740 was kind of the magic number you needed to hit for your credit score. So anything 740 and higher, you know, if you got a 740, that's just as good as a, 750, 800. In the new way, really, you can see that there's new thresholds and new tiers to hit. So there's a different tier for 740 to 759, 760 to 779, and then really the best of the best, if 780 and better is where, clients need to be. If you look here at this chart, so on this section, this is 95% financing, so 5% down or more. There's only a hit of 1/8 to how lenders price out a loan. So that's 0.125% that the client has to pay for the particular rate if they have a 780 credit score and they're putting down 5% or less. The old way, they would have a hit of 0.75%. So that's a substantial improvement to those that have still good credit and that are putting down less money. So it's not meant to penalize those that have slightly weaker credit and more down payment, but it's more to help incentivize and help make those certain brackets into a more affordable bucket, if you will. Also on one of the loan programs for first-time home buyers called a Home Possible or Home Ready that I'll talk about later, there are none of these loan level price adjustments on those scenarios. So that's great for first-time home buyers. It can be eligible for some repeat buyers. That's going to be very driven towards those that make a certain income. But those that are going to be wanting that type of loan program, they're going to be getting this type of pricing here where they don't have the huge hit to the rate just because they're putting down a little bit less money. So I think I stopped my screen sharing now. One of the other changes that they rolled out earlier this year, and again, all these took place and were announced to mortgage lenders in February or March. So the mortgage lenders had to start building in this pricing into their rates. That way, when we sold the loan to Fannie Mae by May 1st, all these changes were already taken place. One of the big ones that just got eliminated was the debt to income ratio. So there was an announcement back earlier in the year that any clients that have a debt to income ratio of over 40%, they were going to have to pay a penalty for that. And I personally did not agree with that whatsoever. And long story short, they paused that and said they were going to re-release it in either August or September. And then just, I think last week, right, Melissa, they said that we're going to eliminate that debt to income price adjustment completely, which was awesome. Because, in our world, we may, set up a file with a 39% debt to income ratio, and then, taxes come in higher, or homeowners insurance or flood insurance comes into play and something pushes that debt to income over 40%. And then the lenders could have been left with having to charge higher, and it can just deal with, a trust issue at that point and just getting people upset. So luckily, those people got involved and, we were able to eliminate that fee, which was a huge win. Other changes that took place, FHA, VA, there's been some great changes that took place there on FHA loans. There's going to be mortgage insurance premium that is financed into the loan. And then there's going to be a monthly mortgage insurance premium as well. That monthly mortgage insurance premium got reduced by about 30 basis points. So that helps improve the borrower's monthly mortgage payment. And then on VA, there is a funding fee. Unless the client has a disability that the VA recognizes, that funding fee is typically financed into the loan. But that actually got reduced by, I think, about 15 to 30 basis points, which is a win. So we'll take every little victory we can get. So make sure that you're kind of remembering those things. If people talk about home ownership being expensive, that there's been some good changes this year, kind of across lots of different realms.
Yeah, and
Um,
on the VA product, which is one of my favorites because they're just more flexible with everything. There's no monthly mortgage insurance on that. It's just that upfront funding fee. And you know, a lot of people misunderstand with the veteran, if they're even 5% disabled, they're exempt from the funding fee. So they don't have to be 40% or 60 or 80 or 100. If it's 1% and they get disability, then they are exempt from the funding fee. And that's a huge deal for these people. Makes a big difference in their loan and the way it's structured.
Absolutely. Another topic that came up this year had to do with FHA and a 40-year term. This is not for new mortgages. This is basically for clients that have an existing FHA loan. They could request from that servicer to basically modify into whatever their existing term is, 15 or 30 years, ask the servicer to modify to a 40-year. So that is not a brand new product. It's just something that's been rolled out to existing FHA homeowners. And then the big question of where are rates going to be going this year? Just, the newest predictions that have come out that I just actually saw last night. So mortgage predictions, as you can see we've got the Fannie Mae predictions, the Mortgage Bankers Association, National Association of Realtors. This has actually changed from what was released even just 30 days ago, but these are the institutions that have the economists analyzing the data, determining where they think interest rates are going to go. I can't say whether I agree or disagree. I don't have any control over it. So all I want to do is just kind of show you guys, take a screenshot of this if you want. Hopefully everybody can kind of see it clearly, but they can see, where they predict interest rates to be next quarter, and then eventually kind of trickling down. So these, I will say these people were wrong last year when they thought interest rates were going to stay in the 5s. And we all know that they went up and kind of flirted with the 7s. So this is all just information of, hey, where do people think rates are going to go?
They got a 50-50 chance.
That's right. And none of us can control it. All we can do is just keep on marching, I think. Okay, so that's kind of the quick highlights of industry changes. We talked about the loan level price adjustments. That is nothing new. They've only just altered or changed what those adjustments are. And if clients have questions to you guys about that, and ask them to reach out to their loan officer, because the loan officer can kind of go through scenarios with them, and they're the ones that have the boots on the ground and give them good, truthful information. Then we talked about the mortgage insurance premium, or the FHA mortgage insurance premium going down, and the VA funding fee going down. And then there is no 40-year FHA term. It's just a modification. So another question next, kind of rolling on to the next topic, loan programs that are available out there and some of the differences. Some of this may be a refresher course for some of you veteran realtors out there. Some of it may be brand new information. For first-time home buyers, great loan programs out there are going to be your 100% financing, such as your USDA loan program, your VA program, if they're eligible, there's South Carolina State Housing, and then there's some other first-time home buyer programs out there, like the Home Ready, Home Possible, and then FHA as well. So I'll kind of talk a little bit about the USDA program. So USDA is 100% financing for those that qualify. It is going to be income specific, and it is going to be property specific. So you can always jump on the USDA website to see if the property that you're listing or the property that your buyer wants to see is in that USDA census tract. the unique part with USDA loans is that it is income driven as well. And we look at, or the USDA looks at, not just the qualifying income. So not just what the borrower one and borrower two makes, but the overall household income. And there's some disclosures that the clients have to sign. So if, you know, mom and dad are going to be buying the house, but grandma is going to be living in the house with them, then that could disrupt that household income restriction that we have. So I believe in Richland County and maybe Lexington, the household income for a household of, you know, 1 to 4 people is right over 103,000. So if mom, dad, and grandpa or grandma have an income, a household income of over 103,500, then they may not be eligible for that USDA program. And Melissa, I know you pointed out a great caveat about the closing cost when the appraised value is higher than the sales price.
Yeah. So if we found, you know, different situations where the borrowers, the reason why they're going USDA is because they don't have, a down payment. So closing costs are hard for them to pay as well. So if the appraised value comes in higher than the purchase price, let's say it comes in $4,000 higher and their closing costs are $4,000, we can add that into their loan. And so literally they can come to closing with no money. So it's a great program. And I think some people forget about USDA, been around for a long time, and they just have a good program for your borrowers who are struggling to get the down payment, for closing.
Another great program, VA, I'll kind of touch on that one with FHA in a little bit. South Carolina State Housing, that's a great loan program too. That's a bond loan that goes off of household income as well. So sometimes clients can make too much money. And, and Melissa, jump in and correct me if I'm wrong, but it seems like, with the USDA income restrictions in South Carolina State Housing, like they're going to look through the tax returns, they're going to look at overtime income, commission income, any type of income to make sure they don't make too much money. So lenders always have to, triple dot their I's and triple, cross their T's to make sure there's not too much money there. Because sometimes we work with individuals, that we don't have to use their bonus income to get them qualified. But if they're going state housing, the state housing is definitely going to check on that and make sure that they're not kind of over.
Yeah. And if it's a one-time bonus or a one-time, income, let's say they won the lottery, they won't count that, but your, standard overtime, bonus that goes every year to year and base salary and stuff like that, they will count that. And then if there are people living in the household, just like USDA, if the grandmother lives with them and she gets Social Security, then even though she's not on the loan, we have to document that income to make sure they're not over the limit. But you do get credits. So if they have children, then they bump up the income, the minimum income requirement, so that it gives you more. You can make more money if you have more people in your household and more children. So. And they also have what we call the non-bond program with state housing for people who may be over the limit and they don't have the down payment. State housing has a option for that as well. That the rate's a little bit higher, but it does take care of their down payment assistance, and it's a good program. It's a good miss for the bond program to do the non-bond.
So, and Melissa, again, that one does not go off of the household income?
No, that one's like Fannie and Freddie's Home Ready and Home Possible, where it goes off the qualifying income. So they don't look at the household income on the non-bond.
Yeah. Okay. And with South Carolina State Housing too, there's kind of 2 different legs for it. So you can have a conventional loan or an FHA loan, and they still fall under that South Carolina housing, bracket, if you will. And I didn't screen share this, but y'all probably all know that the Palmetto Heroes Home Advantage program got rolled out. So teachers, paramedics, nurses, firefighters, police officers, if you guys have these people in your wheelhouse, in your circle of influence, or you see them at the grocery store, you know, if real estate comes in conversation, definitely bring that up, because that's the program that falls under South Carolina State Housing, and that's the money that gets snagged super quick. And when it runs out, it runs out, and they roll it out again next, every April, I think, pretty much. All right. So other first-time home buyer programs, and even for some repeat buyers. So I mentioned earlier, Home Ready or Home Possible. This is a great loan program that you can be a first-time home buyer. You can be even a repeat buyer. This has no loan level price adjustments. It has a lower interest rate, and it has lower mortgage insurance premium. And this does have restrictions depending on where the client is buying. Generally, Richland County, Lexington County, that limit is going to be income of 66,400 or less. It's a great loan program. I've got several clients in it now that, if you compare that Home Ready, Home Possible, again, when you earn 66,400 and less, if you compare that to another like 3% down program, that Home Ready, Home Possible is just that much more advantageous for them. But again, it's got those income restrictions. But something to kind of think about too.
And on those, just to give you an example, if we were taking somebody Home Ready or Home Possible, and their base salary is 60,000, and they qualify, but they made a $40,000 bonus, we're fine. We can still do the loan because their qualifying income was under the threshold of the income requirements. So, it's a good program.
All right, FHA and some other loan programs. FHA, while we love FHA, is, for many different reasons, is that's a lot of times kind of leaning more towards those that have lower credit scores. So if I compare the financing and pricing for some conventional loans versus, somebody with a 620 credit score on a conventional loan versus an FHA, a lot of times that FHA is going to be the better loan program, because it's going to have better mortgage insurance, and it's going to have a better interest rate. And it also allows the lender to push that debt to income limit up a little bit. So those are kind of several different reasons why a lender may, tell you that FHA is going to be the better route for them, is because they can get a higher purchase price with the FHA, and they can potentially get a lower rate and lower mortgage insurance. So, and the student loan qualifications have changed recently for FHA loans. I guess kind of for a while, we used to have to count about 1% of the balance as their student loan payment if it did not show up on our credit report. But now, I think maybe last year it changed where it's only 0.5% of the balance that we have to count. So that means that they could potentially afford for, more of a house, where I know we're all kind of finding that we need more houses that are in the lower tiered bracket. And then the inventory is just kind of light right now with homes in that lower bracket. So FHA is a great loan program. And those are kind of the caveats: the higher DTI, lower rate, lower mortgage insurance premium, depending on the buyer's credit score. So Melissa, anything that you want to add there with FHA?
I think FHA, I mean, they've been around a long time as well, but they're more geared towards your, first time home buyers, or even your repeat buyers, that they're, like Jennifer said, their debt to income ratios may be a little bit higher. And so the, tolerance for Fannie and Freddie, they don't have much on that. They allow some things that, Fannie and Freddie do not allow. Just an example, if somebody works for a family-owned business for Fannie Mae, they would tell us we've got to get 2 years tax returns, which means the borrower has to work for that family member for 2 years and to validate their income. And FHA says, we'll be fine with, 1 year. Another thing is gift, down payment for FHA loans. So for those, you have to put down 3.5%. So the borrower can get a gift for the down payment, and it can be from a family member, like a mother, father, sister, brother, and it can be from a friend. And we've even had, we've even gone in and we have to document a relationship. So like we've gone in and documented a Facebook relationship for, 5 years between people to establish the relationship, but they've got some more flexibilities within that program. So it's more friendlier, for some. It's a good program too.
Yeah. Other loan programs that are out there. This is one I personally have been doing a lot more of. It is called the Family Opportunity Program, and it's kind of been around for a while, but this is a program where it allows for the adult child to purchase a house for their elderly parent because the elderly parent cannot qualify, and it allows for us, the lender, to treat the house as a primary residence, which is huge. This means the interest rate is substantially lower and the down payment requirements are substantially lower. So if the adult child is having to purchase it, say as an investment property, instead of primary home, which is the family opportunity loan, how lenders treat the investment property is, you got to put down 15% down at least. There's a huge break in the rate if that person can put down at least 25%, and that's a lot of money to put down, especially on investment property. Plus the rate's going to be a lot higher. So again, if we can treat the loan as the family opportunity loan and allow that adult child to purchase it from mom or dad, they can put down as little as 5%, and we get to treat it as a primary home, so the interest rate is much lower. Now, when it comes to property taxes, the lender's not really involved on that. That's going to be up to the buyer and up to the county. So usually the older mom or dad is going to be added to the deed. That way Richland County can vet or vouch for the occupant living there as your primary home. But again, the lender does not really get involved on property taxes. That's between the buyer and the county. But that's been a huge program that we've done a lot of recently. Another one that we have been doing a lot is just a loan program where mom and dad want to buy a house for their college age kid. The secret there is we need to make sure that college age kid has established credit. So kind of how lenders set up the loan structure, instead of mom and dad who live in, New Hampshire buying an investment property for their kid, if the kid has zero credit, we need to work on establishing a credit history, because the ideal situation is the child in college has credit. They are going to be on the loan as the primary borrower with a credit score. Then mom or dad, whoever is going to be truly qualifying for the loan, is going to be on there too as the non-occupying co-borrower. So we get to treat it as a primary home. I think you got to put down as little as 5%. You get that primary home interest rate, and then mom and dad co-sign for the loan. So, and again, the ticket there is that student has to have established credit. So if they are 18 years old, don't have any credit, but you caught wind of a conversation that, hey, maybe my mom or dad are going to buy me a house when I'm a sophomore or a junior at Carolina or at Clemson or wherever, or Midlands Tech, then, talk to the client about, hey, making sure that you establish credit, refer them over to us. We can help guide them along the path of getting established credit and giving them tips and tricks on what to do with your credit card or what not to do and so forth. That way, when it comes time to buy the house, we can treat it as a primary home, which is going to be less money down and a far better interest rate. So those are a couple of great programs for those that are buying a home for their elderly parents, and then also buying a home for their child or son. And I just use college as a reference since we're in a college town.
Well, and you can also, on the family opportunity loan, parents can purchase a home for a disabled child, adult child, and it will be a primary residence as well.
Yep, absolutely. All right, another great program that I hope most of you know about, but maybe you don't. And this one is kind of special to resource. If I can get my mouse to work, bear with me. So we all know where interest rates are. They've gotten a little bit ugly. A program that we've got out there is our Resource Express 5-year ARM. This is a niche product, but this interest rate as of today is 4.625. Most rates that we're seeing right now are in the high sixes. We're even seeing some sevens. This is for conventional financing or conforming financing. So when you're dealing with clients that are saying, I don't want to buy right now, rates are too high, or have you heard anything about adjustable rate mortgages? Screenshot this. This is your ticket to having a great conversation. This is just where the rate is today. This rate does not change every single day like most rates do. But as of today, it's at 4.625. It's kind of census tract based and it's client based. So these are always kind of that one-off, hey, Jennifer, did this work for my client and so forth. But this is a fantastic product that a lot of realtors that I personally am talking to are pitching this client, talking to clients about that, because we've got so many people that are scared, to buy right now, but just because of where rates are. So another great thing about this product besides the rate is there is no loan level price adjustments. So it does not matter if you have a 640 credit score or an 840 credit score, the client is still going to get that 4.625 interest rate. It is a 5-year ARM, which means the payment and rate is fixed for the first 5 years of the loan. And whenever I'm talking to clients about this product, and I think probably 9 times out of 10, if a client qualifies for this product, they are doing it. I had one person that did not want to do it because they wanted to put down 3%, and this one requires the 5% down. It's a fantastic product. It's fixed for 5 years, then it adjusts every year thereafter. It's a 30-year term, but ideally rates come down. We refinance them out of that adjustable rate mortgage and then get them into something that's more permanent. So this is a fantastic loan program out there. I will say, just for education purposes, not all lenders are offering ARMs right now, and that's just part of how mortgage lenders have their business model set up. Is most lenders, or a lot of lenders, will sell the loan on what we call the secondary market. So somebody else is going to actually hold that mortgage to the original lender, but if somebody else holds the mortgage, that's called kind of like the secondary market. And that secondary market hasn't kind of reconfigured rates yet to be able to sell ARMs. This is just kind of a niche product that luckily we have the capabilities of offering. So fabulous product. And then you can also do this resource rate program as a fixed rate with no loan level price adjustment. So if you've got clients that don't want the ARM, I can talk to them about the fixed rate too. And again, this has no loan level price adjustments. So all that stuff that Biden did, or whatever people like to say, this does not apply to them. Another common question we're getting lately, Melissa, you can talk about this a little bit, is manufactured housing. I know with development going on and people are having to kind of go further and further out of town to get a house that they want, or maybe they just prefer to be more, out of town. Manufactured housing has definitely come up a lot more in conversation than it had, 2 or 3 years ago. Melissa, there anything you want to add to that topic?
Yeah, I mean, we've definitely seen an uptick on manufactured housing. I mean, we went probably 2 years or more, and we rarely saw one. Now we see a lot of those, and it is an affordable solution for a lot of borrowers. And so I would just say this on those particular loans: if first of all, they need to be detitled or the title retired before closing. The majority of them are. If they're not, we have one particular investor we can actually close it with, that it can be done after closing, but it's a different investor. But anyway, on those, when the appraiser goes out there, he's going to be looking for the HUD tags on the actual unit, and if they're not like 100% visible, then we'll have to order what they call an IBTS letter, basically giving all the serial numbers, everything to that unit. And then if there were any additions to the unit, since it was actually delivered there, so they added a deck, I had one last week that they actually added like a whole room off both sides of the manufactured home. So we would have to get an engineer certification. I mean, all lenders do, to confirm that, the additions are structurally sound and it didn't disrupt, the unit itself. So those are pretty standard. And I've not really seen any issues with those coming in, but definitely we're seeing a lot more manufactured homes. And, we'll be happy to take them. It's a good thing to know if we got to get that IBTS and the engineer certification.
All right, and then moving forward, I just realized the time. I'm gonna speed up a little bit. So I still have a lot more to cover. Outside the box loan programs. So we do offer bank statement loan programs. So you've got your self-employed buyer that's like, Grace, I have trying to get cute with my tax returns. I don't show a lot of income on my tax returns. Well, we can look at a bank statement program for them where we look at all the income that they deposited on their bank statements. There's a few things we might not be able to count, but long story short, bank statement programs, we look at their deposits and we can use those deposits either over a 12-month period or 24-month period to determine what their income is going to be. And then for those of you out there that work with a lot of investors, if investors don't want to give over their tax returns, there's a debt service coverage ratio loan where basically they've got to have the right credit score, they've got to have the right down payment, but we do a comparable rent schedule. And as long as that comparable or market comparable rent schedule is equal to or greater than the mortgage payment, then we can get the loan for them. So again, investor program, the market comparable rent schedule that the appraiser, calculates is going to be equal to or greater than the mortgage payment. So two kind of outside the box programs that are definitely available. Closing cost tidbit. Don't forget, whenever you're negotiating closing costs, we've definitely been seeing that coming up more lately, which we love. Whenever the seller is giving the closing cost to the buyer, you kind of best practice, always check with the lender that is going to be doing the financing to see what the closing costs are, because if you negotiate $7,000 in closing cost, number one, we need to make sure that conforms to guidelines. And number two, we want to make sure that the closing costs aren't like $6,000, because then you got a difference of $1,000 there that the seller was willing to give. And if there is too much money there on the table, then the seller just gets to keep that money and the buyer, it kind of loses out. So make sure you check with your lender on that. The rules, vary. So VA is 4% for closing cost concessions from the seller. Melissa, do you want to comment real quick on the VA closing costs? Because this is an awesome strategy.
Yeah. So, and we've had a couple loans that we've closed like this. So for VA loans, the 4% does not start counting until you are outside normal, usual, customary closing costs. So if attorney fees and appraisal and title search and all of those, let's say they total up to $4,000, that doesn't even calculate into the 4%. The 4% is above your usual and customary charges. So it's very different from every other program. And with VA, the seller can actually, if the borrower or the veteran's having a tough time qualifying because of a debt to income ratio, the seller can pay some of the buyer's debts off at closing. So we've had a few people that this is exactly what they did. They wanted to utilize the 4%, and that's what they did. So, it is a good, it's misunderstood a lot in the industry because of the way the other programs work and, the way they count the closing costs, but VA is very different.
Let's see, FHA is 6% for seller concessions. With conventional, what concessions are allowed for the seller to pay depends on the loan to value. And it also depends on the occupancy. So if if your buyer is doing conventional financing, traditional W-2 tax returns, whatever, and the seller is going to help pay for closing costs, they can only pay up to 2% for the closing costs. So investment property is definitely a lot different than the second home or than the conventional programs. All right, so a couple of other things on, government-backed loans. I know I mentioned earlier that with FHA, it allows for a higher debt-to-income ratio. Same thing with VA. I mean, VA wants to get the veteran buyer into a home. So they allow higher debt-to-income limits, and they, want to do everything they can to get that veteran into the loan. A question that we always have come up is, what is Tidewater, the dreaded T word? And so, Melissa, do you want to talk about kind of just real quick how Tidewater works and kind of the steps and some best practices, especially with like the FHA or VA addendum clause that has to be signed?
Well, on VA, well, both FHA and VA, FHA has their mandatory clause, and then VA has their escape clause, which basically says that if the house isn't appraised, for the sales price, then the veteran has the opportunity to renegotiate. So they require those to be, executed. A lot of times they're already in the sales contract. That makes it super easy. If they're not, then before the notice of value can be issued, they'll require that we get those forms signed. And then on Tidewater, we, have the opportunity to go back to the agents and get some some comps that, you guys feel would be supportive of the value. And then that goes back to the appraiser, they review it, and then VA gives the final okay. And so, some examples, and this isn't Tidewater, this is actually the opposite end of the spectrum. When people were overbidding for houses last, fall, there were situations that I saw that the appraisal came in lower than the sales price, but then when VA actually went in to review it and issue the notice of value, which is the actual value, they ended up going with the purchase price. So they, like Jennifer said, they very much want to get the veterans in the homes, and they want to make sure that the value is supported, and they give every opportunity to get to that point. So those loans are the easiest ones, in my opinion, to get through. And then there are some misnomers on like the appraisals. So, and this is a good thing for y'all to know, on FHA loans and VA, if the house was built before 1968, you have the whole lead-based paint disclosure that y'all provide. Well, if the appraiser goes out, and let's say the home was built in 1960 and he notices peeling paint, then he's going to condition that be, removed and by someone who is trained to do that with lead-based paint. If they were to go out, the appraiser were to go out and that had already been fixed, it would not be an issue because they would not see the peeling paint. So, that's one thing. And then also on FHA, any additional structures that are on that property have to meet HUD's minimum property standards, just like your actual home that, is being sold. So if they have like a shed that looks like it's about to fall down, the appraiser and HUD's going to say, okay, either knock it down or get it up to, code so that we can, close on the loan. Any kind of health or safety issue is what the appraiser's kind of looking for. They don't hit the appraiser, the reports for every little thing. They do not on FHA and VA. If you don't have coverings on the electrical outlets, that's a safety issue. And even a good conventional appraiser will, ask for that to be taken care of. And, last but not least, besides the VA program, when we're talking about appraisers, we have a panel of appraisers that we have used since 2008. We do not use an AMC. We've worked with these people for many, many years, and they will pick up the phone and call us if there's any kind of issue. So if you ever do, your loans go through resources, know we've got people who actually know the market and have been here for years.
I kind of want to finish, and hopefully I got a little bit more time before Q&A starts, if we have any, just kind of thinking about different strategies out there. you know, recasting of a loan is typically a strategy that lenders can use. So if a client has house A that they need to sell, but they qualify to float both house A and B, you kind of have got to work with a situation here where they've got all this equity tied up here. Well, we can do a bridge loan where we tap into the equity in house A. This is kind of, I guess, two segments, two different strategies. House A, we can give them a bridge loan. I just did this on a house that somebody was buying downtown. Got a house in Forest Acres that had, 50,000 equity in. We gave them a bridge loan so they could help buy house B. They used that bridge loan to close on house B, and they were able to obviously float, all three payments and so forth. So don't forget that bridge loan is an option that we can do here to help them get into their next house. With that, with tapping into the equity. A second possible strategy would be recasting. So if you, for some reason, can't do a bridge loan, but somebody's got all this equity in the house, they only want to put down 5% on the new house, but they're sitting on 100 grand that they just either can't tap into or don't want to for whatever reason. Typically, and this is a conversation that the buyer needs to have with the lender, they can take the equity out of the house that they have sold and apply it to the new house that you just sold them, that they financed, and that servicer can then apply that large principal payment to their mortgage and then recast the loan so that borrower or that buyer has a lower monthly mortgage payment. So it's got to be done a certain way, but just kind of know, and call me after this or send me a text. We can talk more about it, but just know that if you're listing a house and that client's sitting on a bunch of equity that they are going to eventually roll into the next house, call me. We can talk about the recasting option where they use that large principal payment to the new mortgage and then have their new mortgage recasted for lower payment. Listing agents, don't forget about temporary buy downs. We can definitely have plenty of conversations about this. This is where your seller takes some of their net proceeds and applies it towards a temporary buy down for the buyer that gets that buyer into a lower rate and lower monthly payment, either for the first 1, 2, or 3 years. It is on a fixed rate loan. I know there's a misconception out there about, well, this is just an adjustable rate mortgage. It's a fixed rate loan. It has been a practice that's been around for at least 20 years since I've been in the industry, but it just hasn't been very popular. Don't forget gifting sources. If you talk to somebody that says they don't have any money for a down payment, send them over here. We do lots of digging and lots of exploring to try to see, well, if you don't have money for a down payment, we're going to explore the South Carolina housing loan. We're going to ask about different gifting sources. And I think, Melissa, you said earlier, a friend had gifted money to a buyer on an FHA loan. So that's kind of a little trick there. A couple of best practices, don't forget that even though we're in a higher interest rate environment right now, one thing that I know we are rolling out at Resource Financial that I'm sure other lenders are too, but we've got the rate reduction program. So you guys screenshot this too. So, there's the phrase out there, marry the house, date the mortgage rate or what have you. So, with the clients that we're helping now purchase homes with these higher interest rates, we are offering this program to them saying, hey, buy your house now if you can afford it, if you feel comfortable, and if you're qualified. And then when rates come down, you can refinance. And, our company is waiving the lender fees and we are reimbursing back the appraisal fee on that refinance. So we're trying to continue to promote home ownership, get more people into houses, and help them with their closing costs on the refinance. And, obviously they would need to use us on the purchase and on the refinance, but I know a lot of realtors that I work with are using this in their conversation pieces to help get those buyers, continue to keep them excited about buying a house. And then, don't forget, as at our company at Resource and me as a loan officer, we work with you guys as a team. We are all here for the end game of getting people into homes. We want to do it ideally seamlessly. And obviously we get you guys closed on time so you can get your check on time. So we always think of ourselves kind of as an extension of you. And so if you are working with us now, ideally, phone lines or, in text messages, open, clear conversation. I'm going to do everything I possibly can to try to help you win that bid and win that offer for your client. So whether it's calling the listing agent and vouching for how solid the pre-approval letter is. So whether it's us you're working with or another lender, we just like to think of the lender realtor, really being a partnership. I'm very good friends with a lot of my realtors, and I love that because, we're all in this to help people get into homes and to do it the right way. So we're very blessed to have an awesome community here in Columbia and Lexington and the outskirts, and just know that we're all here to help kind of get your clients and our clients over to the closing table on time, and send everybody on their merry way so they can work on the next family. But all right, it is 12:53. I have talked a long time. So is there any questions out there that I can answer?
Jennifer, we had one question that I started answering, and I said you may need to touch more on it. But one person mentioned, I'm told that the banking crisis is not over. What impact is that having on lending, the approval process, and rates overall? Same question relative to the debt ceiling, please. So I just mentioned that the rates, we've seen a small uptick in the last couple of months in the rates, but as far as the approval process, that itself has not changed. I didn't know, we, kind of saw what they're predicting for the rates, but I'm not 100% sure on the whole debt ceiling, issue, or, if you want to add anything in there.
I mean, when things start to get rocky like that, I mean, the rates can go one or two ways. And once inflation starts cooling down, we'll start to see mortgage rates, decrease as well. A lot of times lenders keep their eye on the 10-year treasury to see the direction of where interest rates are going to go. But from, a credit capacity standpoint, I haven't really seen anything tighten up from a lending approval standpoint. But I mean, at the same token, I mean, here we are, May 15th, 17th, and we've already seen a tremendous amount of change in our industry just with these loan level price adjustments, and they threw some out and they took some back. So, we just got to keep our boots on the ground and being able to control what we can control. And the debt ceiling, we can't control that. But, we're still getting loans through underwriting. We still have plenty of sticky situations too, where clients, we're trying to, put the puzzle together. So I really haven't seen that many changes between what I personally am doing. And Melissa, you can speak because you see a lot more various files than I do, but I really haven't seen that much of a change between what we're doing today versus what we were doing, a year, 2 years ago.
Yeah, and the beauty of, we are a mortgage lender. That's what we do. That's all we do. With the banks, they do a whole range of offerings, and so they may pull back some on mortgage. But as far as your independent mortgage bankers, we have like 25 different investors. So we're a boutique lender, and we just specialize on getting people into homes. So it hasn't really impacted us, other than we have seen a small uptick in rates. And, that kind of, some people get a little skittish about buying something if the rates are going up, but they're still not bad. I mean, when I started in the business many years ago, they were like 13, 14, 15%. This is not bad. It's just different. And, but anyway, I think as the year progresses, it will get better as far as the rates will go down some, but I don't know that we're going to ever go back to 2.5% or 3%. And I don't know that we need to hope for that.
Yeah. And I will say too, it definitely comes up in conversation about, are we in a housing bubble? What's going to happen with rates and with the housing industry? And, we are not in the environment that we were in 2008. For those of you that were in the business then, we've got such a housing shortage inventory right now, plus mortgage loan guidelines are just vastly different than they were in 2008. So I think from a credit approval and availability standpoint, as long as you're dealing with clients that are, are happy and comfortable and can afford the mortgage payment, and they're not, trying to outsmart the system, because in 2008 people could basically just have a name and a credit score and get a loan. So
Yeah.
now everybody's kind of gotten a little bit smarter, and there are going to be, most of the time, credit score requirements, and there's going to be down payment requirements. So things are a
Yeah.
lot.
We're definitely, since '08, it's very much responsible lending. Jennifer, they want you to show your contact information again, and then I want to make sure everybody remembers that we're having our happy hour here tomorrow night at Lady Street from 4 to 6, and we do this once the third Thursday of every month, and it is open for anyone to come. It's a great networking event. Jennifer will be here. We'll have a lot, and I'll be there, and we'll have other people from Resource there. And we usually have a pretty good turnout. So we'd love, for people to come. Jennifer, I have one more question, and you may have to email the answer if we don't have time. But the question is, the news made Biden's executive order sound like people with higher credit scores would be paying higher rates to help people with lower interest rates. What you showed today seems quite the opposite. Can you clarify?
And I can definitely do some one-off scenarios. So I wish I could remember. I heard something on the news 2 weeks ago, and I almost shouted and pointed at the TV and said, that is false information. Like, these reporters don't, we all know that their job is to report the news, but it's also to sell their news story, and it's clickbait. So I would advise your client to, call me on the phone or whatever lender that you are using and talk to a real live lender. Like the loan level price adjustments, they have always been there. Like, I've been doing this 20 years. There's always been adjustments there. They have just changed some of the adjustments. And yes, so some people that are buying, or those that are buying second homes and investment property, they pay a lot more. So those adjustments there have definitely increased in the past, 15 months.
But there is more of a risk with those loans too, and that's why they make those kind of adjustments. As the industry changes, they adjust the risk threshold levels and adjust it accordingly.
Yeah, and the policies that are rolled out are to try to promote and encourage those that are in that lower bracket of being able to put a much down to, trying to push that home ownership and that affordability. So it's all about reinvesting in the community and getting people that may not have been able to afford houses before, to give them that incentive. So they still had that adjustment there, 5 months ago. Just that adjustment is lower. And one thing I wanted to add too, so there's my contact information. I do, not 100% of the time, but typically on Wednesdays, I will send out what I just call my Wednesday Wisdom video, and I send it to my realtors that I've got in my database. And I'm trying to give you guys either mortgage news you can use, or tips, or market rates, or updates, or some type of little quick 60-second, maybe 2-minute video on something that I hope can be impactful to you, educate you guys, talk to you about Tidewater or CL 100s, or, things like that. So if you guys are not already getting my Wednesday Wisdom updates and you would like to, there's my cell phone number. If you just want to text me your name and your email address, I would be happy and would love to add you to that. So I can send you guys that. So, and it's kind of just like what we talked about today, plus, some rate updates or anything, great that we've got going on. And thank you guys so much for allowing me to participate. And I hope you found it worthy of your time, which I know is so precious.
Yeah, thank you so much. And I just want to let everybody know this was recorded. And so you can find this just for your reference, or to show anybody in your office. It's going to be posted on our YouTube page as well. All right. All right. Thank you. So I'll just stop now.